Hi guys. So after a 3-year long break, I've decided to start posting content again, and hopefully it's more useful this time around. So I'll be solving paper 3, Feb March 2018. So your A2 MCQs economics paper. I'll try to go as slow as possible and explain every single option in an MCQ. However, if you think that's too slow, feel free to speed up the video on YouTube and watch at a higher speed. However, or conversely, if you think I've missed some explanation or something requires more detailed explanation, feel free to ask about that MCQ in a comment below and I'll try to explain it there. Without any further ado, let's proceed with the paper. So question 1, in a cost-benefit analysis, so where you look at social benefits and social costs and see whether a project is socially beneficial, the term net social benefit refers to. So what you should know about social benefit is social benefit is the addition of private benefit, where private benefit is the benefit that the economic agents involved in the exchange acquire, as well as external benefit, use the bad handwriting, or positive externalities to the third party. Social cost, conversely, is like private costs summed with external costs, so negative externalities. However, they haven't just asked social benefit, they've asked net social benefit. So the implication of the word net is you're looking at the overall or the total social benefit after you factor in the social cost. So net social benefit essentially is just social benefit minus social cost. That's the way you compare social benefits and social costs and see whether the benefit is actually more than the cost or not. So that's the important thing, the word net here. So just look at it. Social benefit minus social cost, your answer is D. All the other options for this explanation would be wrong. So like private benefit plus social benefit would just not fall within this particular formula, the explanation of which I just did. Let's move on swiftly to part number 2. So a government school is built by private builders in a residential neighborhood. The builders ignore the effects of noise and disturbance. And usually noise and disturbance is a negative externality or an external cost. So it'll affect everyone else in the residential neighborhood, but won't really affect the buyers or the sellers of this particular service, the service of builders building a school. So why does the free market fail to take into account these external costs of building the school? So usually why the free market does not take these external costs into account or any external costs or external benefits into account is simply because it doesn't really affect the people that are involved in the purchase or the sale of the service. So the government is essentially hiring and purchasing the builder's service. They don't particularly care. The builders themselves won't care because they only care about their private benefit or private costs. They don't particularly, at least in economic theory, care about the negative externalities the residential neighborhood has to bear. So option A says education is public good, which benefits society. Education is actually not a public good if you apply the metrics of non-rival and non-excludable, because it is non-rival for just one example, because if there's one more student in a classroom, that takes away a spot from someone else. So it's actually not a public good, but again, it doesn't answer the question either. Few people who live near the school object to the building, but the point is not whether people object to the building or not, or people whether they complain or not. The point is the free market doesn't care. It doesn't account for it, irrespective of whether they complain or not. It should still ideally account for it. The government believes that schools should be built privately. I mean, sure, the government is building schools with private builders, but whether or not you're building it privately doesn't necessarily mean explain why the free market does not care about the negative externalities. So this is just unfortunately irrelevant, leaving us by elimination of part D, which is these costs are not paid for by the builders. So since they are not paid for by the builders, they don't come into the ambit of the builder's private costs. And since in the market economy, in a free market economy, the builders will only care about their private costs and private benefits. Since they don't have to bear the brunt of the cost of noise and disturbance, they're not paid for by the builders, they won't really care about it. And that's why it doesn't take into account external costs or any sort of externalities, essentially. In question 3, in all market structures, so irrespective of whichever market structure you're looking at, monopoly, free market, monopolistic competition, and many more, what must firms equate to ensure allocative efficiency? So the thing you should know with allocative efficiency, let's just try to highlight this a little further. is that allocative efficiency is achieved irrespective of the market structure, where firms are pricing according to marginal cost. So price should be equals to marginal cost. Now, there's the entire theory behind this as to why that ensures allocative efficiency on the scale of a firm. I'm not going to go into this specifically. I do believe most people at this stage, while attempting past papers, do know this. Even if you don't know this, just the knowledge that price should be equal to MC for allocated efficiency is enough to do your past papers. If you need more explanation, feel free to comment below and I can explain in more detail. So price should be equal to marginal cost. Now, the problem here is you can see marginal cost here. You can see marginal cost here, but there's no price. So the answer is C, but let me explain why. And the basic reason is because your average revenue is essentially price. Some people just memorize this, but let me explain why average revenue is essentially price. So let's look at total revenue. Total revenue is essentially price multiplied by quantity. So the amount of units you're selling multiplied by the price at which you're selling each unit. If you look at average revenue, AR, so average revenue is total revenue divided by quantity. That's the formula for any average. Like you take the amount and divide it by quantity. And we know total revenue is price into quantity. So we just substitute this here. And as you can see, these two things would cancel out, leaving you a price, which tells you our average revenue is equals to price. And that's perhaps an explanation that hopefully makes sense as to why they try to trick you a bit by saying average revenue here. But essentially what they mean by average revenue for our intents and purposes is price. So yes, they must equate marginal cost and average revenue, which and price, which is what we said here. Price is equals to MC. And that should be our answer. You can also do that through a diagram where you would intersect it with demand. I thought this was an easier way to explain it. In the diagram, a consumer's budget line shifts from JK to GH. So JK, this one, this was the initial budget line, and then it shifted to GH. So before we proceed, let's just give some background regarding what the budget line signifies. So the budget line, and hopefully you all know this, but the gradient of the budget line, the gradient, again, my apologies for my terrible handwriting, is minus price of the quantity of good X or whatever good there is on the X-axis divided by price of good Y. So again, here are quantities, but the budget line shows the ratio of the prices. Where do you get this ratio from? Well, there's a very elegant proof to that, but it's not so relevant for your A-level syllabus in most cases. So I'm not going to go over that. This is just something you should ideally know and keep in mind. So the gradient is minus Px upon Py. Now let's look at what's happening to the gradient, because it's kind of shifting in this way, right? Now, if you look at the line GH, and hopefully all of us are reasonably familiar with math to a certain extent, but when it's becoming less steep or flatter, you could say. So when a line is less steep or flatter, the gradient is decreasing. When the line becomes steeper, the gradient increases. When the line becomes less steep, the gradient decreases. The absolute value of the gradient. I'm just ignoring the sign for just a second. The sign just tells us it's a downward sloping line. So what this essentially means that Px upon Py, since it's becoming less steep, this is actually decreasing. So why would this decrease, right? This would decrease maybe because Px decreased, maybe because Py increased. There can be some other combinations as well. So this is just to give us a bit of a background before we even look at the question. But let's see what they've asked. They've asked which statement must be correct. So the must is important. It has to be correct. We can deduce that for sure from the information given above. Part A says there has been an increase in the consumer's money income. Now this is important. Real income is very different. Real income takes into account prices so that you can figure out your actual purchasing power, right? Like how real income takes into account inflation. Money income doesn't take into account prices. So money income is just like, oh, if you're earning, I don't know, $100 a month, and hopefully you're not earning just that, but if you are, it doesn't care about prices or anything. It's just the nominal income, you could say. It's just the money income, the actual value of the income. So this does not depend on prices. And the difference, the change here is a change in the relative price. Like either price of X has changed or price of Y has changed or both have changed. So we can't make a comment on the money income because based on the information here, it seems to have stayed the same. It's just a pivoted shift, which means that the prices have changed. Part B says there has been a decrease in the consumer's real income. Now, what you should know is that your real income increases if your purchasing power increases, usually when prices decrease, so you can buy more. And your real income decreases if your purchasing power decreases, usually when prices increase, so you unfortunately can buy less. Now, from this, what we can deduce is if you look at it, there's a relative decrease in the price of X, which is also shown here because you can buy more quantity of X if you just buy X. There's a relative increase in the price of Y relative to the other price, which is also shown here because if you think about it, you can buy less of Y, less quantity of Y. So the impact on real income is unclear because the decrease in price of X does positively impact real income, but the increase in price of Y, the relative price of Y, negatively impacts real income. So it's not a must be. Like it could be a decrease if you buy more of Y than X, but it couldn't be. It could stay the same because these are two opposing forces. So we're unsure about this, and thus it can't be the solution of a must be correct question because there's not enough information provided to verify point B. Point C says good Y has become relatively more expensive, which is actually what we discussed. We discussed that if this is happening, this means that good Y, the price of Y has increased with reference to X, which the relative aspect is just indicating that it's in reference to the other product. So good Y has become more expensive. Price of Y has increased. So that is the correct option for those reasons. And we explain why we came down to this, to these two impacts previously. And the price of good X has increased is just like clearly wrong because the relative price of good X has decreased. So that also, for the similar logic, answers why the price of good X has not increased. If anything, the relative price has decreased. Let's go on to part 5. The table shows substitution and income effect for a normal good and for an inferior good as the price of the good changes. So the first thing you should know is with substitution, it doesn't matter which good it is. The type of good does not matter. Simply what happens in substitution, let me just write this here, in your substitution effect, always, irrespective whether it's a normal good, whether it's an inferior good, whether it's a different good, the substitution effect is constant across all. If price decreases for a good, you will buy more of it. If price increases, you will buy less of it. This basic law of demand that we studied all the way back in AS and in O level. So this is very simple. And I think that can help us eliminate some answers because we don't have to look at the type of good right now. Let's ignore the income effect as well. Let's just look at the substitution effect because that's the simplest effect. If the price falls, i.e. the price decreases, we know that you should be able to buy more by the substitution effect. So because if a good's cheaper, you would substitute in favor of it, i.e. you would try to buy more of it. So the demand change from the substitution effect shouldn't be negative, it should be positive. So we can just cross this out. So A is automatically just out of question. If the price change is an increase, then the demand should fall by the substitution effect. So this is fine. If the price change, again, we're ignoring this column for now. If the price change is a fall, then the demand should rise. Again, the inverse relationship. So this is also fine. And the price change is a rise. So if price rises, then quantity should fall. The demand effect should be negative, not positive. So we can cross this out as well. So we didn't even look at the type of good because we know the substitution effect does not depend on the type of good. It's the same across all. So now let's look at the type of good. And what you should know is for a normal good, if your, let's call it YR, so your real income, it's important, not just your nominal income, but your real income, which indicates your purchasing power. If your real income increases, the demand also increases, simply because, well, if you have higher income, these are usually better quality goods, you want to buy them more. And the converse is also true. For an inferior good, if your real income increases, the demand decreases. So there's an inverse relationship. Simply because it's a lower quality product, if your purchasing power has improved, you would rather not buy these products. The important thing here, as opposed to what we learned in like AS, is we're looking at not just your nominal income, but your real income. Your real income basically takes into account price changes and is your purchasing power, so what you can actually buy. Now let's try to apply that here. We're only looking at these two options anyway, so we already eliminated the other two. So the type of good is inferior. The price change is a rise. If the price change is a rise, your real income, I'm just denoting it by RY. I mean, I don't want to write the entire thing, but your real income would fall. Why is that? Because the price change is a rise, right? So the prices have increased. So your purchasing power has decreased. You can buy less now because it's more expensive. So your real income has decreased. And if your real income has decreased, we know for an inferior good, there's an inverse relationship. So if your real income decreases, your demand should increase by the income effect. Not talking about the substitution effect, the income effect right now. The reason why this is wrong is because it's saying the demand should have a negative impact versus decrease. So we can, by that logic, eliminate. And just to sum this up, with a normal good, if the price changes a fall, your real income would increase because they're like the good is cheaper, so you can buy more, you have a higher purchasing power. And if you have a higher purchasing power for a normal good, that's a positive relationship. So demand should also increase by the income effect, which is also what it states in because it states positive, and that's why C is your right answer. A government imposes a $10 tax on each unit produced of a product. How will this affect the firm? So it's just going to increase your cost for every unit. Every unit you produce, you have to pay a $10 tax. So every unit you produce, it would increase the cost. Let's just rub this so that we have some space. You can also just use the new color. Right. So how will this affect the firm? Its average cost will rise by less than $10. This is untrue. The average cost will rise by exactly $10. So if you have this graph, the quantity and average cost, if this was your old average cost, it will just rise by exactly $10. And the simple reason for that is because every unit you're producing, there's a $10 additional tax on it. So the average cost is essentially trying to figure out your per unit cost. Like if you have 10 units and the overall cost is 100, then it's trying to figure out the average cost for every unit. And thus, if we know on average or just generally, every unit costs $10 more, then the average cost will just increase by $10. So the change would actually just be exactly $10 for no matter what quantity. You can also prove this mathematically, but it's probably a little more tedious. So this might be a better way to explain it just logically. Its marginal cost will remain unchanged. This is untrue. The marginal cost will also increase by 10. So maybe initially the marginal cost is $5, but now every additional unit you produce, you also have to pay a $10 tax. So it increases your cost with every additional unit by 10 on top of your marginal cost. So your marginal cost would increase. It would increase by a value of $10. It would not remain unchanged because the marginal cost is just the cost of the addition in total cost when you produce one more unit. Now the addition total cost is not just the original marginal cost, it's also a $10 tax, which will also count within the marginal cost. Its minimum average cost output will be lower. So it's talking about output here. So it's saying that your minimum average cost, which is basically like these things here, the output would be lower. So instead of this value Q, you would be producing something like this, Q1. But as we can see, since the average cost curve only just increases by $10 on every single point, it just shifts directly upward. There's no reason why your minimum average cost output should be lower because every point just shifts upwards by $10. So this will be wrong by that logic. And its minimum average cost output will remain unchanged. Again, the minimum average cost does increase. So this was the original minimum average cost. Now it's gone up. So the average cost, the minimum average cost has increased. They're asking the minimum average cost output, which is this output. that remains the same because it's just a vertical shift up. So the shape of the curve still is preserved. So the minimum point would still occur on the same value of Q. All right, question 7. According to oligopoly theory, oligopoly, well, it's a market structure where a few large firms dominate the market, so somewhat similar to a monopoly, but like a few large firms rather than just one large firm. What is not likely to characterize the behavior of firms in an industry? So we have to look for the odd one out rather. So matching any price cuts made by the rival, this is an oligopoly industry exhibiting behavior, because in an oligopoly, you don't want to be outdone by your rival, like within the few major firms. So if they reduce price, that's what a price cut is, you will also reduce price in order to match that. Matching any price rises made by the rivals. This is the correct answer, because you want to gain market share and be the firm that becomes the market leader. So you want to try to edge out the other big firms, your other big competitors, the 2, 3, 4, 5 other people that you have. So you will match a price cut because you also want to remain competitive. Otherwise, if you don't decrease your price as well, matching a price cut is essentially if they decrease their price, you will also decrease your price. Because if you don't do that, then you won't be competitive, then everyone will switch to your rivals. Here, you will match, you won't match a price rise, because if they're rising their price, you're like, sure, go ahead. I'm also a large firm with good products and economies of scale and all of that. And thus, if you increase your price, I won't increase my price just so that I can knock out my rivals and essentially mess them over and then grab their market share. So this is something that won't happen in an oligopoly, which is why it was not likely to characterize the behavior. Sell a range of similar but differentiated products. That is true. It's true for both monopolistic competition and oligopoly. It's similar products. There are a couple of large firms. They do try to differentiate it. And the ability to earn supernormal profits does exist. Since it's an oligopoly, they can collude together and hike up prices and earn supernormal profits that way, among many other ways. The diagram shows the cost and revenue curve of a monopolist whose only cost of production is a fixed cost. So which means total cost is usually fixed cost plus variable cost. In this case, there are no variable costs, it's only a fixed cost. And variable costs are costs which vary with your output. Fixed costs are costs like that are just fixed, that will exist even when the output is 0, and they don't vary with your output. So stuff like the rent of a factory. The rent will always be the same every month, irrespective of how much you actually produce from the factory. So what will be the monopolist profit maximizing price? Now, what you should know about profit maximizing price, again, I won't go into the theory of this, but something you should know for your MCQs is that it's always MC is equals to MR. Marginal revenue is equals to marginal cost. But the question you have to ask here, this is where it gets interesting. What is marginal cost in this case? So marginal cost is if you produce one more unit, how much does it add to your total cost? But here, there are no variable costs. There's only fixed costs, and fixed cost does not vary if you produce one more unit, 2 more units, 3 more units, fixed cost remains the same. So if there is no variable cost, if you increase production by 1 more unit, you essentially have no more additional cost. The fixed costs remain the same and they're there from the start. So there's no variable cost. That's what they've said. And because of that, since the variable costs are 0, the cost of producing an additional unit is also 0. Like the fixed cost would remain the same, like there's no additional cost to it. And thus marginal cost is 0. So now MR actually has to be equal to 0. And you will have this labeled, so MR is equal to 0 here. And you try to go upwards using the demand curve to figure out your price. And it's point T. So MR is 0, this is the output you should produce for profit maximizing price. And then once you've decided your output, you use your demand curve, which is your AR curve, by the way, is your demand curve, to figure out with what price you have to charge. So company R manufactures steel. Company S produces ships. Company T operates oil tankers, and company V operates cruise liners. So lots of information. Which statement is correct? If R, which produces steel, takes over S, which produces ships, this is an example of forward vertical integration. And I believe this is correct. So for vertical integration is when in the same production cycle, you just integrate alongside that. So something like an oil company buying a petrol pump, for example, it's the same production supply chain line, you're just merging in that. And it's forward because it goes towards the final product. So it is forward because if company R merges with company S, it is the same production cycle because like steel is used to make ships, and it's forward because it's going from steel, which is the raw material, to ships, which is the finished product. If it had been the other way around, it would have been backward. So that's correct. And let's look at the other options. If S takes over V, so ships takes over cruise liners, this is an example of backwards vertical integration. Like, no, it's not vertical integration because these are both finished products, cruise liners and ships. So you're not really vertically integrating. It would be vertical integration if it's like instead of ships, they're also like, you know, either took over steel company or took over like an oil company, something of that sort. If T takes over S, this is an example of diversification. So if oil tankers takes over ships, it's an example of diversification. Not too sure about this. Like you could argue that it's an example of diversification, but you probably need more information regarding what sort of ships and how different they are, and thus whether it's actually an example of company T diversifying, or are those ships very similar to oil tankers? But this, I will give you that this is an option in which you can try to make an argument in favor of it. However, a good rule in economics is that if you have two options, and you will get many MCQs where there are two options, both of which seem okay or correct, you go with the one which is more clear-cut, the correct answer. So this is the more clear-cut, the correct answer, because it is a textbook example of forward vertical integration. Here, is it an example of diversification or not? Kind of depends on exactly what sort of ships. So it's more vague, and thus we'll go with the more clear and clear-cut answer. And I'm actually glad this came up because this happens a lot in economics, and you have to just go with the answer that's more obvious or like this seems more likely. If V takes over S, so cruise liners takes over ships, this is an example of horizontal integration. Well, no, not really, because horizontal integration is like if you take over another company in the same stage of production. So these are in the same stage of production, sure, but within the same industry. So cruise liners and ships are still different. So they not really in the same industry. And thus this is not going to be your answer. A monopolist chooses an output that maximizes profit. So we know for a monopolist, profits are maximized when MC is equals to MR, and makes normal profit. What you should know is normal profits is where essentially you're not making super normal profits. So your average cost is equals to your average revenue. So the average cost that you have is the same as your average revenue, and that's what we call normal profits in economics. If you're making more revenue, like more average revenue than average cost, that would be super normal profit. So these are two things that you can just immediately pick from the question, and I would advise people to just like start picking things from the question as soon as they read it, so that they can go a little faster. What must be, so this is important, it has, like it's a must, like it's not, it could be, it has to be correct at the output chosen. So the output you're going to pick is, since it maximizes profit, you're going to pick this output, whatever MC is equal to MR leads to. And incidentally, that will also, in this case, imply AC is equal to AR because we're given this information. But let's see the options and figure it out. Average cost equals average revenue. Yeah, that's also correct, because we know since they do make marginal profit, MC has to be equal to MR because it maximizes profit, but AC also has to be equal to AR for normal profit. So average cost equals average revenue is exactly correct. This will also be correct if it was an option. I assume it's not. But like both of these two things are correct based on the information we have been provided. Average revenue equals marginal revenue. Again, this doesn't correspond with this. Marginal cost is at its minimum, not necessary. This has to be equal to marginal revenue. Monopolist is allocatively efficient, is again price is equals to MC. And price is average revenue is equals to MC, which is not the same as any of these two things that we have picked from the answer, from the question. So we can be confident in crossing this out as well. Okay, question 11. A firm operates in an imperfectly comparative market. So it's a competitive market, but it's not a perfectly competitive market. It's some version of that, maybe monopolistic competition or maybe something else. The prices of its products are determined by the maximum price each consumer is willing to pay. What describes this pricing method? It's discrimination. This would be like very intuitive to you if you've done your theory, and let me explain why. So the price of the product is not a fixed amount. It's determined by the maximum price each consumer is willing to pay. The maximum price is literally what it seems like, is that the highest price a consumer is willing to pay. If you go higher than that, they'll just be like, yeah, I don't want the product anymore. But each consumer is willing to pay. So every consumer's maximum price is different. So for an ice cream, for example, the maximum price of one consumer might be $5. The maximum price of another consumer who might be a little richer could be $10. Like they're willing to pay a maximum of $10. Maybe someone else really loves ice cream. So the maximum price they're willing to pay is $7. Maybe somebody hates it. So they're like, yeah, I'll pay $2, but if you go higher than that, I won't buy the product. So the maximum price differs based on every consumer. And thus, the price you charge, since the prices of the products are determined, they're not a fixed amount, they're determined by the maximum price each consumer is willing to pay. And the maximum price is different for each consumer. The price of the product will be different for each consumer. And that is the definition of price discrimination, where you discriminate between consumers and charge different consumers different prices for the same product. Akin to demand curve is something you see in an oligopoly, which is not the case here because it's still a competitive market. Limit pricing is the concept or the situation where you price extremely low to deter or eliminate entry to the market. It's kind of similar to predatory pricing, except predatory pricing is slightly different in terms of that's where you price your products low to kick out people, other firms from the market. This is to prevent firms from entering the market in the first place. So that's limit pricing. Again, this is different. Price leadership, well, that also happens in an oligopoly. Usually you need a market leader for that to set a price. In a competitive market, an imperfectly competitive market, but still a competitive market, it's unlikely you'll have a market leader in the first place. It's still a competitive market. What is an argument for government policy which allows companies to take over other companies? So companies to make acquisitions, so to acquire other companies and thus become larger companies. So it's kind of moving towards the process of becoming an oligopoly or becoming a monopoly. It allows firms to borrow from the banking system. I mean, that's not dependent on how large the firm is. Like many small firms can also borrow from the banking system. A large firm could also borrow from the banking system. It's not really contingent on that. It encourages companies to act to promote productive efficiency. But this could be it, and I think it is it actually. Let's look at the other options, because if there's a policy as per which other companies can just acquire your company, if your shareholder price drops or if you're just not making a profit, that is a big incentive to become productively efficient, which means producing at minimum average cost. So trying to drop your average cost, trying to cut costs and become as efficient as possible, because the fear of other companies that might take over your firm would exist. So there's not going to be any slack or complacency. So that's a good argument to make in favor of this policy, which is that it could encourage companies to really act very efficiently. It ensures wage rates will rise, not necessarily. If anything, when companies reduce to one or they monopolize, they usually become monopsonies as well. So it's like one firm hiring in the labor market as opposed to many firms. So there's not as much competition while hiring for labor. So if anything, wage rates usually reduce there because the power imbalance shifts. It provides income and employment for, for investment bankers. I mean, it could. It could provide income and employment. It could also not provide income and employment. It's not so clear what the link with investment bankers and acquisitions is, especially based on our syllabus. But even if it does provide income and employment, it's not really the argument for government policy. Like governments don't want to make a policy just because they care about investment bankers. They probably care about the larger economy and the larger market in general. A government imposes a maximum price for electricity. So a maximum price, like a price ceiling. Let me just quickly draw the diagram for this. Quantity, price. Here you have your demand, your upward sloping supply. This was the original equilibrium price. Now, in comes the government with the maximum price, which is a price ceiling above which you cannot price. And for it to be effective, you have to impose it below the equilibrium. If you impose it above the equilibrium, there will be no effect. The equilibrium price will still go on. This is your max price. Right, let's call that PM. So what this means, if you look at where it intersects the supply and demand curve, where it intersects the supply curve gives you your quantity supply. So this is the quantity suppliers are willing to supply at this lower price, which makes sense. They're willing to supply less because the price is lower, so they can't make as much money off of it. But the quantity demanded is actually greater because it's cheaper, so they just want more. Like they're willing to get more electricity. So, and you can clearly see there's a disparity, which leads to shortages, simply because the quantity demanded exceeds the quantity that's actually supplied. So let's now look at the options. It will encourage electricity suppliers to invest in additional capacity. Probably not. If anything, they will reduce capacity as explained by this diagram. It will increase the incentive for consumers to conserve energy. I mean, why would they conserve energy? They want more electricity now because it's cheap. So they're like, yeah, give us, I'll demand more electricity. I don't want to conserve it anymore as much because like it's cheaper, so I can just consume, I can afford to consume more. It will prevent the monopolistic exploitation of consumers. This is a statement that can justify this measure. Again, that's what we're looking at, which statement justifies this measure. So which statement in favor of imposing a maximum price. And that's true. You can't have monopolistic exploitation where prices are really hiked up or prices are raised by a lot because there's a ceiling, there's a price ceiling, there's maximum price. The price will be low. It can't be dragged up to be really high, which could happen otherwise. So that's a good argument. That's an argument which can justify this measure. The first two definitely can't. Let's look at the last one. It will prevent the rationing of electricity through power cuts. It will actually make it worse, to be honest, because since there'll be a bigger shortage now, because there's more quantity demanded than quantity supplied, there's a greater shortage. If there's a greater shortage, you'll have to ration electricity even more through more power cuts and load shedding and things of that sort, because the shortage is just worse right now. The diagram shows a change in a market when a government places a production quota, OQT. So OQT, so this is the production quota. A production quota essentially is that you can only produce this much. You can't produce more than this. Like we study import quotas, you can only import this much quantity. So you can only produce this much quantity. And yeah, it was previously trading here at OQ. This was the original equilibrium. Which welfare loss results from this government policy? Now, if you really have this on the tip of your fingers, you would know it's X plus D. That's your deadweight loss. But if you don't, not to worry, we can explain it as well. So let's try to rub some of this. So initially, your consumer surplus, if this is the price, right? If this is the price, this is the equilibrium point. Your consumer surplus is this. So the area below the demand curve but above the price level. And your producer surplus is this. The area below the price level but above the supply curve. Right? How does that change? Let's observe that. Now at QT, the price will be this. Like if you take for the consumers. So you take the price, you take the quantity, you look at the demand curve and the consumers are willing to pay this price. So this will be the consumer surplus, which is the area above the new price and below the demand curve. And for your producers, the area below the price and above the supply curve, obviously not going to that region because you're not even producing in that region, would be this. So while the consumer surplus does lose out on W, it's captured by the producer. So all of this is still welfare that is still acquired. So V is the consumer surplus, W plus Y is the producer surplus. But X and Y is lost out. X is lost out from the original consumer surplus, and V is lost out from the original producer surplus. And thus X and Z are just lost out and they aren't acquired by anyone. So that's just welfare loss. It's like loss of producer and consumer surplus that no one gets to benefit off of. And thus this is the welfare loss for this policy. Which policy by a government would increase negative externalities to external costs that result from cigarette smoking? So stuff like either littering of cigarette butts or passive smoking, when people smoke and people around them suffer from the consequences as well. A ban on cigarette advertising. So this word, all right, so let's highlight this. The government with which policy would increase the negative externalities, not decrease it. So you want to decrease the negative externalities, but it's asking the opposite, which policy would actually do the unintended and increase the negative externalities, which is not what you want. So a ban on cigarette advertising, as you've studied, advertising is a factor affecting demand. If you don't have advertising, you have less demand and thus less people consuming cigarettes. So if you have less people consuming cigarettes, automatically the negative externalities like passive smoking would obviously decrease. It wouldn't go all the way to zero, but it would just decrease. So this would decrease the negative externalities, not increase it. A ban on cigarette smoking in public places would also help reduce passive smoking, especially because a lot of passive smoking happens in public places where other people are around you. So if you ban cigarette smoking in public places, that would decrease negative externalities, not increase them. A ban on substitutes for cigarettes. Now this would increase negative externalities. Because if there are no substitutes for cigarettes, like vapes or nicotine patches or nicotine gum, then instead of consuming the substitute, people would just consume more of cigarettes. The demand for cigarettes would increase. This is what we studied in AS, where we studied if the price of your substitute increases, they become more expensive, the demand for your original product increases. Here, the substitute is not even becoming more expensive, it's just getting banned altogether. So you have no choice but to go back to the original product, that is cigarettes, and just consume that. So the demand for this would increase, the consumption would increase, and naturally, if there are more people smoking, you would have more negative externalities. A ban on the sale of cigarettes would do the opposite and would reduce negative externalities, which is why we can cross this out, because naturally, if you can't buy cigarettes, if it's illegal to smoke them or sell them, there will be less cigarettes consumed and thus less passive smoking and less things like negative externalities. All right. A teacher currently earns 30,000, but would be willing to continue to do the job provided she earned at least 25,000. So this is what we call transfer payments. Transfer payments are basically the lowest amount you are willing to accept to stay in your current job. And this is the wage you're actually being paid, which I think we can also classify is that the wage you're being paid is essentially economic rent plus transfer payments. So transfer payments, the minimum amount of wage that you will accept to remain in the job, and economic rent is all of the stuff you'd earn on top of that. She prefers to stay in her teaching job, then change to her next best alternative as an accountant where she could earn 40,000. So the other alternative is an accountant where she earns a different amount. But again, that different amount doesn't change the transfer payment and economic rent breakdown of her current job. So which statement is correct? Her economic rent as a teacher is 5,000. This is true. The subtract wage with transfer payments. So wage is 30,000. Transfer payments are 25,000. So the difference is 5,000. So she earns 5,000 above what her minimum amount is, what the minimum amount she'd be willing to accept, and that's all economic rent. This is correct. Her economic rent as an accountant is 10,000. Now, we can't comment on that because we know that as an accountant, she could earn 40,000, but we don't know what's the minimum wage she'd be willing to accept as an accountant, and thus we can't figure out the transfer payment and then subsequently the economic rent. So we can't make a comment on the economic rent of her as an accountant, nor her transfer earnings of her as an accountant. All we know is the wage she'd get as an accountant. So that's a bit of a curveball that they try to confuse you guys with, but like they haven't given us enough information to even consider those options. Her transfer earnings as a teacher are 30,000. Well, no, they're 25,000 as we discussed. 30,000 is her actual wage. 17. What will increase the power of a trade union, allowing it to increase wages without reducing employment of its members in a particular industry? So we need to increase the power of a trade union. The economy is experiencing a fall in the price of capital. This is the opposite. If capital is getting cheaper, employers might want to shift to capital intensive means of production, which means more capital than labor. And this doesn't help, because if capital is cheaper and you're like, hey, give us more wages and don't fire us, they'll just be like, why would we do that? Because capital and machinery is actually cheaper than labor, or at least is getting cheaper relative to what it was before. So we just go towards a capital intensive means of production rather than hiring as much labor. So that's not a situation where you're very powerful as a trade union, because your employer can easily hire more capital because the price is low, like more machines and stuff. The economy is experiencing rising employment. This could be true, because if there's more employment, that's usually indicative of like a booming economy, like where aggregate demand or production is just increasing, which usually means that people are buying your product, the consumption is high, and that's why people are hiring people. So if there is rising employment, that could be indicative of how, it's a booming economy and aggregate demand and consumption and all those things are increasing. And thus, the employer can afford to pay higher wages without reducing employment, because they're just selling more. The demand for the products is increasing, so they can sell more and sell more at a higher price. So they can afford to pay higher wages, and they don't necessarily have to cut costs by firing people. So this could be your answer. Let's just put a small slash on it just to see the other two options, because this is not so directly true. It's like something we're inferring, but we can solve by elimination in most cases in such scenarios. The PED of the industry's goods is equals to 1. Now, so this is the case of a unit elastic demand, where the idea is if there's a change, it is a rise in price, the quantity demanded decreases by the same percentage change, which I'm sure you studied in AF. And the implication of this, which is the more important thing, is no matter how much you increase or decrease price, quantity demanded increases or decreases by the same amount, such that total revenue always remains unchanged. Total revenue does not change. So this is wrong. Why? Because if the elasticity is equals to 1 of the products of the goods that the industry is selling, and you're asking for higher wages means total cost increases, because you're also saying don't cut back, don't fire us. So total cost can increase, but even if they increase price, total revenue will remain the same. So clearly, this is just a horrible strategy for them, because they're just going to reduce their profit, because the cost will increase if they increase wages, and the revenue will remain the same. So no, they won't listen to a trade union, and trade union will not have as much negotiating power in this scenario, because they're just asking for total cost increase. And even if the employer tries to increase revenue by increasing price, it's not going to work, because it's unit elastic. The PED of the industry's goods is greater than 1. Now, this is also wrong, because this is elastic. The price elastic demand of the goods. This is not elasticity of labor, by the way. This is elasticity of the final goods, of the goods that these laborers are actually producing. What does elastic demand mean? It means if you increase price, which you might want to do because you're having higher wages, so you would want to increase price to pass the impact of higher wages onto the consumer. But if you increase price, quantity demanded reacts by a greater than proportionate amount. So quantity demanded drops by a lot, which means total revenue also decreases. So here, if you increase price, you're just going to receive a drop in total revenue. And if you don't increase price, you're just going to see an increase in total cost without any way to compensate for it. So here again, you're not in a very particularly strong position to negotiate, because the firm is not in a position to absorb those wage increases by passing it on to the consumer in terms of a higher price increase. The table shows the number of workers employed by 4 firms in the same industry, the average number of hours worked, and the total output each firm produces each day. Which firm's workers have the highest productivity? So productivity essentially is just like you measure it in terms of the output one worker produces in 1 hour. So in 1 hour, if you just have one worker, how much are they producing, like on average? So to figure that out, you can look at total output. This is by total output is for all workers across all of the hours, divided by the number of workers. So you can get it per worker. And also divide this by the number of hours worked. Why the number of hours? So that you can get it for 1 hour, that you can actually figure out and compare total output, or rather the output you produce for on average for a singular worker in just 1 hour. And that's the way to compare productivity. So just use the formula to pop all of these things in. Let me do it for a bit, for a few options. The number of workers are 4, average number of hours worked per day. And we're all talking about it in just 1 day, so we don't have to worry about the number of days. Average number of hours worked per day is 8. So 4 workers working an average of 8 hours means there's 32. Like if I multiply the denominator, and then total output goes in the numerator. So 320 divided by 32, that's 10. 5 into 7 is what? 35? Yeah. So, and then this is going to be 420 divided by 35, which if you pop it to a calculator, tells us 12. 6 into 7 is 42. 42 divided by 462 divided by 42 is 11. 7 into 9 is 63, and that should just be 10. The highest productivity is for option B, that's 12. So it produces 12 units. So on average, one worker, an average worker, in 1 hour produces 12 units. That's what this is telling us. You just use this formula and you get the answer. Which stage of the business cycle is most likely to be characterized by an increasing negative output gap? So it has to be a negative output gap. And I think the fact that it's a negative output gap kind of excludes recovery, because recovery says you're going from a recession or a trough or a slump to a positive aspect. A boom also indicates like a high positive output gap. You're producing a lot, things are going well. So this is also not a negative output gap. Like just to give you an idea, like something like this, like maybe more of a positive trend. So, well, let's try to use a different color. Yeah. Somewhere here would be your recession. So this is where the economy is going into recession, which means that your output is reducing. It's on the down, it's also reducing. And your trough is just like the absolute bottom point, which is in some books, or some teachers also used to like to call it a slump. So both of these are like negative, like they're both like the output gap is negative, you're going in a downward spiral, but you need an increasing negative output gap. In a slump, the output gap isn't increasing, like it's not getting more negative. It's gone as negative as it wants to, and now it's gonna improve. There's no increasing negative output gap, which is why you can exclude your slump or your trough, whatever you want to call it. Recession is where the output gap is negative. It's also getting more and more negative, so it's still increasing, like the negativity in it is increasing. And that's why option B. Which characteristics are typical features of least developing countries? Dominant sector of industry should be primary, which is why they often don't earn a lot, because they just export raw material, agro-based products. Export earnings have to be unstable. If they have stable export earnings, they would have like a decent amount of money, probably would not be least developed. And well, that just automatically gives you your answer. But terms of trade, so the ratio of export prices to import prices, this is also unstable because, well, the prices fluctuate depending on the crop and the output, and your currency also varies. In Pakistan, for example, or maybe some of the African nations, like their currency depreciates and fluctuates quite frequently. So because of that, the terms of trade is also unstable. But again, you had your answer in the first two columns only, but relatively straightforward. What is central to economic growth, but not necessarily economic development? So economic growth is just like increases in GDP, increases in output, essentially. That's just economic growth. Economic development is a little more. It's looking at whether the standard of living is improving. So that's where you look at stuff like the Human Development Index. That's where you look at pollution levels. That's where you look at mortality rates, number of doctors per 1,000 people. So it's a lot more, and like distribution. So your GDP might be increasing. Your GDP per capita might be increasing even. but how is it distributed across the economy? So development is a lot more nuanced, it's a lot more holistic. It's looking at whether the standard of living actually is improving. Growth is just like, increased GDP, increased GNP, increased output, stuff like that. So what is central to economic growth? Well, clearly, as we just discussed, it's the increasing gross domestic product, because GDP is a factor of economic development, yes, for sure, but it's not necessarily the central thing. It's not necessarily the main thing. There are so many other factors that I just highlighted. An expansion of the range of economic choices available to individuals is not central to economic growth. It's just GDP. Economic growth does not care about absolute poverty eradication. It just cares about producing more, having greater GDP, whether that's distributed well across the country or whether that's distributed so unequally that there's still absolute poverty. Economic growth doesn't really care, doesn't take that into account. And the same logic applies for the satisfaction of basic needs among the whole population. Economic growth doesn't really take distribution of income or income inequality into account at all. What would be the essential element in listing countries in order of their standards of living during a particular year? So we're basically looking at the standards of living, so like stuff like economic development in a particular year. So let's look at that. A deduction for profits transmitted abroad for the figures for gross national product. Well, they've explained how you would calculate gross national product from gross domestic product, but as we just discussed, gross national product, GNP, GDP, these aren't essential items in listing countries' standards of living, because you could have a high GNP, but you could still have a very poor average standard of living if the GNP is not distributed equally across the country, or if the GNP comes at the cost of very high degrees of pollution. For example, in India and China, lots of cities, even in Pakistan, are suffering from high amounts of pollution. So the standard of living doesn't actually improve in that case. So the GNP, similar to GDP, is not the essential element in figuring out standard of living. Allowance for different rates of population growth. Not too sure about what they mean by allowance. Like if you don't understand a particular option, usually that means it's not it. But even if you're looking at different rates of population growth, like sure, some populations have more growth than others, but is that really an important enough factor, or a factor you can use to order the standards of living? Not really. Like as a general trend, developing countries do have a higher rate of population growth, but that's not the essential element. That's like one of the primary elements that you can use to actually characterize and say this country has a higher standard of living, this country has a lower standard of living. Some countries might have higher rates of population growth, but still be able to better feed and clothe their population than countries with smaller populations as well. An adjustment for the inflation rates of different countries. I mean, you should adjust for the inflation rates of different countries, because that gives you an idea of the purchasing power. So this could be an option. Let's keep this in the bank. The use of purchasing power parity exchange rate. So what are purchasing power parity exchange rates? Essentially, it's just a mechanism which figures out the cost of living in different countries, looking at their exchange rate, looking at their inflation rate, and fixing both of that. So for example, the cost of living in the United States is very different than the cost of living in Pakistan. So the purchasing power parity will then use this to figure out the cost of living in both of the places, and then make a better judgment about the standard of living based on the per capita GDP. They want to say, oh, like there's more money in one country as opposed to the other country. It'll say, let's compare the cost of living in both countries, and then just look at which has more money per person, and that's how you can make an idea of the standard of living. So we crossed out the original two. Now, while C is a fair thing to say that you should adjust for inflation rate, purchasing power parity does already account for inflation rate to figure out cost of living. It also accounts for the differences in exchange rates as well. And thus, it's just like a much better way than just looking at inflation rate. So it's a much better way to calculate cost of living, which is why C is fine, but D would be the more essential element. And we've asked about the essential element. Like you can argue in favor of C, but like you have to look at which is more true in a way, or which is more compelling. And that was D for the reasons we just discussed. a government wished to increase demand in an economy. So they wanted to increase aggregate demand in an economy. Since we are looking at the economy as like from the macroeconomic lens, it's not just one firm, it's the entire economy. In an attempt to reduce unemployment, which makes sense. Usually when you increase aggregate demand, like there's more production to match that aggregate demand, and thus there's more output, there's more employment, and you reduce unemployment. So which policy is most likely to achieve this? So you need some sort of expansionary fiscal or monetary policy. Establishing greater health and safety rules for manufacturers, that's not a fiscal or monetary policy. It's not really a demand side policy at all. And if anything, establishing greater health and safety rules for manufacturers just increases the cost of production for manufacturers, because they have to give like more health leaves, and like they have to spend more on the safety and like regulations. So if anything, this will just disincentivize them from producing. I'm not saying these things are not important. I'm just saying if you just look at this, those will probably mean in the short term, at the very least, manufacturers might produce less because production is more costly now. So you don't reduce unemployment, you actually increase it. So the opposite. Increasing income tax. If you are increasing income tax, you are reducing disposable income because more income is paid to tax. And if there's less income, there'll be less consumption, and thus less aggregate demand. So the opposite of what we're trying to achieve. Because aggregate demand is C plus I plus G plus X minus M. Right? So if C just decreases, AD will also decrease because you have less income. Increasing the rate of interest. So if you increase the rate of interest, what you will do is increase saving. Why will people save more as opposed to consuming? Because they're getting a better interest rate. So instead of getting a 2% return on their savings in the bank, let's say they're getting a 5% return or 10% return, to be very optimistic. That means there's more value to save in the bank as opposed to consume. So instead of consuming, like because they have a limited amount of income, instead of using that income to consume, they will use that income to save. Like not all of it, obviously, but like a greater proportion of it will be used to save. So you will in fact have higher savings. And for the reasons we saw above, if you have less consumption, you just have less aggregate demand. So that doesn't really help increase demand. Subsidizing the building of new houses. And this is cleared up, subsidizing, it's cleared up a government expenditure. We've seen there's a direct relationship. If government expenditure increases, aggregate demand increases. You'll also reduce unemployment because there's more demand, like you'll use some workers to build these houses. So that'll open up more jobs and things of that sort. What would be an increase in leakages or withdrawals from the circular flow of income? So the leakages or withdrawals you need to look at are essentially taxation. So that takes money from the circular flow of income in the economy to the government. It could also be savings, taking money from the flow of economy to the bank, or it could also be money spent on imports. So taking money from the flow of economy from the circular flow of income within an economy, taking that money and giving it to a foreign country from which you're importing. So let's look at that. Increasing government spending on anti-smoking campaigns. I don't think that would increase leakages. If anything, it's an injection in because it's government spending. So I don't think this is it. Increase in spending on imports of luxury cars. This is definitely true because we're spending more on imports. So like money from the flow of income within your economy is being leaked to another country from where you're getting the luxury cars. This is it. Increase in spending on transfer payments. Transfer payments are basically payments that you make for which no subsequent good or service is provided. So if you pay your plumber for him to fix the pipe, that's an actual payment. But if your grandmother just gives you 5,000 rupees as Eid for Eid, that's a transfer payment. It does not require you to like fulfill any duty, any good or service for her. So that's simply a transfer payment. So transfer payments are still like, as long as it's happening within the economy, it's not really necessary, it will increase leakages or withdrawals. So most transfer payments at the very least wouldn't do so, and thus that's the wrong option. Increases in wages paid to government employees. I mean, if government employees are being paid wages, that's just an injection by the government, and in a way, to pay government employees, So it's more spending by the government. So it's an injection, not a withdrawal. What is used to measure the deflationary gap? So the deflationary gap essentially is like the amount of output you are currently on, as opposed to if you had full employment, what output you could produce. So it's like full employment output minus your actual output, you could say, or your current output. So that's a deflationary gap. If you produce more than full employment, that's your inflationary gap. So what is used to measure this? The increase in injections needed to reach full employment, that seems to be quite about right. So how much more spending, or how much more export revenue, or how much more investment would you need to reach full employment? That's the gap. So this would be how you can measure it, like the additional amount of injections, where injections are either export revenue, government spending, or investment that you require to reach that full employment output, which you currently are not on. The public sector borrowing requirement. I mean, the public sector borrowing requirement is dependent on lots of things. I'm unsure how it links here. There's also a private sector borrowing requirement, so it is very unclear. The public sector borrowing requirement is more so linked to your budget deficit, where your budget is, I can't write for anything, where your budget is so put it simply, your tax revenue minus your government expenditure. So the budget deficit would then require the public sector to borrow, but the deflationary gap is something quite different, as we just discussed. So they're just trying to trick you here. The rate of deflation is linked to prices. Deflation is the persistent and sustained decrease in prices. This does not talk about the deflationary gap, which is essentially linked to output. So it's different. The rate of unemployment, again, links to how much is excess labor or unused labor there is, not necessarily how much excess or how much potentially excess output there could be. So it's essentially still looking at labor where it should be looking at output. Right. Yeah. So the following data describes an economy's consumption function. So how much they consume. And they've given us income levels and subsequent consumption levels. What can be deduced about the value of the marginal propensity to consume, so your MPC, in this economy? All right. So, okay, this is actually an interesting question. So I want you to be very careful about what your MPC is, because I'm sure a lot of people will get this wrong otherwise. MPC is the change in consumption that's brought about if there's a change in income. So if income increases by $100, how much does your consumption increase by? That's MPC. This is different. This is very important than your APC, which is your average propensity to consume, as opposed to your marginal propensity to consume. Average propensity to consume is just consumption divided by income. There's no change involved. So here we have to be looking at change, because we are looking at MPC, and we have to not look at APC. The APC is probably decreasing as income increases, but that's not the MPC. So the first year, you can't calculate the MPC because you have no previous value to actually compare it with. So we're just going to look at this step. So the MPC here will simply be the change in income is 40, 100 to 140. So 140 minus 100. So that's your change in income is $40, like $40 million, whatever. And the change in consumption is 90 to 122. So that's an increase of $32. So you can divide by 4, so that's 8 upon 10. So that's 0.8. Now let's look at, you can use your calculators in this paper. So it doesn't, the calculations don't matter so much. That's the way to do them does, but like not the actual numeric calculation. Now we looked at this step, which is the first step, because before this we can't compare it with anything. Now let's look at this step. The MPC here, again, the change in income is again 40. This is 30. Oh yeah, the change in consumption is also 32. So it's still 0.8. If you look at the final step, 180 to 220. So the change in income is still 40. 154 to 186. Let's pop the calculator. 186 minus 154. 186 minus 154. And the change in consumption is still 32. This is also 0.8. So your MPC has actually remained constant of 0.8. What is this? Be careful of this option, because here it says the MPC decreases as income increases, which is usually the case in the real world, but it's not the case in this data. And they'll ask you about this data, not the real world. So you just can't use your intuitions about the real world and answer here. You have to look at the data. Also, if you look at APC, if you just did, 90 minus divided by 100, 122 divided by 140, 154 divided by 180, 186 divided by 120, you would be taking this option but that's APC. That's just consumption upon income. We have to look at change of consumption upon change in income. That's MPC. So be careful about that. That's something that people could potentially get wrong. In which circumstance will there be an immediate increase in the domestic money supply? So the amount of money, the amount of notes, coins, things like that exist in the economy, in your local economy. So that exists, the amount of rupee notes or coins or whatever that exists in Pakistan, for example, not those that exist abroad, because we're talking about the domestic money supply. So we need an immediate increase. A consumer takes advantage of an overdraft facility to buy a car. An overdraft facility is just where you withdraw some money from the bank, but it's overdraft. So you take more than the money you have. Just think of it as a loan from the bank. Now, what this has done is that there was money in the bank that wasn't part of the domestic money supply. It was just like in reserves or whatever, in the bank's reserves. You've borrowed from the bank. You've taken a loan from the bank. And what that means is there was some money in the bank which wasn't being used. And in fact, there was your money in the bank, sure, but then you took a loan from the bank, and then you used it to buy a car. So now it's in the car dealer's hands, and it's money that was previously not part of the domestic money supply, which now is, because you took a loan. So in this case, there would be an immediate increase in the domestic money supply. A consumer uses a reserve of cash to buy a car. Well, the reserve, it's cash, right? So the reserve of cash, whether he or she is keeping it in their pillow or whatever at home or wherever, that was part of the domestic money supply before they bought the car and part of it after. So there's no real increase or change in the domestic money supply. A consumer uses a reserve of euros to buy a car abroad. I mean, if you're buying a car abroad, then who cares? Because it's going to affect their money supply. It's definitely not going to increase the domestic money supply. Let's suppose if you're in Europe, if you're in like, I don't know, France, for example, and you use euros to buy a car abroad, if anything, that's reducing the domestic money supply, not increasing it. It's increasing the money supply of whichever country you're buying the car from. A consumer uses their current bank account balance to buy a car. Now, this is slightly different than this. They're both very similar. But here, you're taking a loan, which is where the increase in the money supply is coming. Here, you're just using your money, which was just part, well, I don't know why I actually cut that, which was just part of your bank account to buy a car. So the immediate increase in the money supply would be more pronounced here, and the loan aspect is where the increase comes in the money supply. So that's where you're taking money that otherwise wasn't there, that was at the bank. This is just you using your own money, just except it was just placed in the bank. So that's why D is not as compelling as A is. The turning point of the Kuznets curve for income inequality. Let's just draw this real quick. So I mean, it's a curve you see very frequently. I think it's also used in Laffer curve analysis, but it's like this upside down U. And what do we have here? So here we have GDP. Well, GDP per capita, but like wherever. I'm just gonna write GDP for same like the lack of space. And here you have some measurement of income inequality. How do you measure it? We've studied it in some of our notes, but again, not so concerned with it for this MCQ. And it says the turning point is this. So the turning point, like this is where it's turning, It's a stationary point if you've done a bit of differentiation, but even if you haven't, this is where like the tip comes and it turns and goes flips back, is 10500 GDP. So $10500 GDP per capita is where it turns, it flips. So what's the curve telling us? It's telling us before this point, as you increase GDP, income inequality increases. So as GDP per capita increases, income inequality increases. This is usually where we see growth and growth which is not so equal. So what we have seen in a lot of Asian economies at the start. But then after a certain amount of time, or after a certain amount of GDP per capita, in this case 10500 USD, then when you grow more, when you have more GDP, income inequality decreases, i.e. you become more equal, you become more developed, you start to distribute income more fairly. Now, what does the question actually ask? Because that's probably a little useful. For a country that has a GDP per capita of 8,000, which lies at the left of this, because 8,000 is less than 10,500, so 8K, let's place here, which is most likely? A reduction in GDP per capita will have no effect on income inequality. This is wrong. If you reduce GDP per capita, you will reduce income inequality, as the graph shows. A reduction in GDP per capita will increase income inequality. Again, it doesn't. If you reduce GDP per capita, it reduces income inequality, not increases it. An increase in GDP per capita will have no effect on income inequality. I mean, again, if you increase GDP per capita, it will increase income inequality because the curve is going upwards. Leaving us with this, which says an increase in GDP per capita will increase income inequality, which is what it's showing. Like if you're here and you start to increase GDP per capita, you can clearly see that it will increase income inequality to bring you back to the curve. 29, which macroeconomic policy aims are most likely to complement one another? Not like there could be many correct options here, but we have to look at the most likely one. High growth and low inflation. I mean, these are usually quite contradictory claims and not so complementary claims. Simply because high growth usually comes from like expansionary fiscal or monetary policies. So you're trying to increase your aggregate demand and grow through that. But in most cases, if you increase your aggregate demand, you're faced with some degree of demand push inflation. So it's very difficult to grow and still keep low inflation. High growth and low unemployment, this should be right, because usually when you try to push for high growth, you increase your aggregate demand. That does lead to like more consumption, more demand for goods, and thus more production. So you're producing more, and if you're producing more, you have more jobs. So you have lower levels of unemployment, i.e. a higher employment rate. This should be your answer. Let's look at the rest. Low inflation and low unemployment, this is again contradictory in most cases, because if you have low unemployment, you usually get low unemployment by like, again, having higher levels of aggregate demand, trying to grow the economy. But if you have all of this, then it's very difficult to have this, as explained here, because you run into demand push inflation. Low unemployment and a balance of trade surplus, where the balance of trade is your export revenue minus your import expenditure. So a balance of trade surplus does help. So if you have a balance of trade surplus, that means you have high levels of exports and low levels of imports. You're earning more from your exports. So the revenue you get from your exports is more than the expenditure on your imports. That's money flowing into your economy. And that can be used in various ways to reduce unemployment. Like just the fact that you have so much exports does mean that lots of people can be employed there. So that does usually mean it could mean low unemployment. It could not as well. So it is possible. I'll give this particular option that much credit, that this is possible, but you have to look at what's the most likely. So when they say most likely, expect two options which are both possible, but you have to look at which one is more probable, which one is more likely to occur. Now, if you examine this in a little more detail, notice that a balance of trade surplus might help with lowering unemployment, but there are lots of more important factors for lowering unemployment, like local aggregate demand and stuff of that sort, as opposed to growth. Like high growth is very essential to low unemployment. So this is the less, it's not as strong of a link, but also low unemployment does not prove a balance of trade surplus. Like having low unemployment has very little to do with the balance of trade surplus. You could still have a balance of trade deficit, for example. So the two, like this way at least, it's not so likely. It's not that confirmed. Here, it's a lot better because high growth is the most important factor for low unemployment. If you have growth, you have output, surely you'll have low unemployment, rather than just looking at the output in your export industry. And low unemployment also reinforces high growth, because if you have more people working, that essentially means you're using as much amount of labor, so as many resources as possible, and you just have more people working, and thus you'd be producing more and helping out with growth. So that's why, while this could be correct in some cases, it is definitely a possible situation to have both of these policy aims side by side. But this is just like the more likely one. It's the more conventional one and the stronger link, which is why we'll go with these. These are the MCQs, which are a little more tricky because they're most likely. All else remains unchanged. What would result in an outflow of capital funds from a country? So like the money people have saved in your country or kept or invested in your country, what should happen such that the money just goes away to another country or like back to the home country? Usually this is linked to some sort of variation of interest rate fluctuation. But let's look at the options before we make a comment like that. A fall in the country's rate of inflation. I mean, if the rate of inflation of the country falls, that does mean, that would usually mean that there's a higher purchasing power of money in that country. And if anything, that should mean more people should want to keep their money in that country, not less. But it's still like not so relevant in the first place, because like capital funds, these are saved in the country, in their banks or otherwise. So it's very unclear as to why the rate of inflation should meaningfully matter, especially a fall in the rate of inflation. If anything, a fall should just make the country more attractive because the money will have more purchasing power in that country. An expected appreciation of the country's exchange rate. So the country's appreciation of the exchange rate means that the currency of the country is getting stronger, which means, if anything, you should be investing or keeping more capital funds in the country, not taking them out. Because if, let's say, people have kept capital funds in Pakistan and the rupee strengthens, so it becomes more valuable, then the value of the money they've kept in Pakistan will also increase. Like the rupee value of, if they've kept their money here in rupees, that will also now be more valuable. So if anything, that would have an inflow of capital funds, not an outflow of capital funds. An increase in foreign interest rates, and this seems to be the correct answer, because let's suppose this is your home country. Let's suppose this is some foreign country that we're talking about. If foreign interest rates increase, the reason why hot money and capital funds will have an outflow from our country to an inflow for the foreign country is because they're getting a better rate here. Like if it's an increase in interest, then there's like more value to saving here, or at least more value than there was before when there was an increase in interest. Because if you save here, like you get a higher interest rate on it. So it's likely that I'm not saying all money will go out, but like some hot money, some capital flows will flow out of our home country to whatever foreign country or countries where an increase in interest rate has taken place. So this increase in foreign interest rate would result in an outflow of capital funds. Increase in foreign prices, if anything, would just reduce the purchasing power in foreign countries and comparatively make the purchasing power of the home country better. So it's not so relevant, but even if it was, it just improves the inflow, not necessarily with outflow. And yeah, there you have it. All 30 questions, an entire paper just completed. I hope that made sense and was useful. If you have any questions or any suggestions or clarifications or even like corrections to point out, feel free to do so in the comments. If you want me to explain a particular MCQ in more detail, you can just ask in the comments below. And if you liked the video and you feel it's useful, do subscribe and do spread the word. All right, this will be it for this particular paper.